have no idea. It's fine. You ain't got no cooties, do you?
No.
I'm okay.
And I put you another one in the freezer for tomorrow.
Thank you.
Unless you want to have it today.
Hello, everyone. I am just walking in the house from the gym. So once again, you have me as I am. I literally just walked in the door and sat in this chair. Okay. So we are going to get started. Whew. Okay, this is episode 30 for Wednesday Live. Before I get started, please click like and share if you would. It is appreciated. And if you are new to the channel, please click subscribe, whether you're on Facebook or YouTube. And you'll be notified of when King's Legacy Group goes live. So welcome back to King's Legacy Group, the financial literacy segment on Wednesday Live. Remember, Saturday Live is for the personal and mental wellness topics. So, as usual, the disclaimer. The information shared is based on my own opinions, experiences, practices, and insight into the strategies suitable to my life and financial wellness for my family. King's Legacy Group employees and its guests are not financial advisors unless they duly state so. And its videos are for informational, educational, and entertainment purposes only. You must do your own due diligence and seek professional advice when you feel the need to confirm or expand your understanding of any topics covered on this platform. Always remember to make smart decisions that suit your own needs and do your own research and analysis. So tonight we are resuming about getting started with long-term investments. So just to briefly mention what I mentioned last Wednesday, it is so simple. Even if you are not ready to purchase stock right now, you can use this time to set up your accounts on whatever platform you choose to get started with, whether that be Robinhood, Stash, or you want to step up and go to a brick and mortar brokerage firm. Like I use Vanguard. Some of you may be familiar with Fidelity, Charles Schwab, TD Ameritrade. Those are brick and mortar brokerage firms that have been around for generations. Platforms like Robinhood are on your device apps, and you can utilize those. Honestly, Stash and Robinhood helped me understand the process better at my own pace as I was learning how to get started with investing. So you can use this time to just set those accounts up and play with them, scroll through them, read through them, reach out to not tech support, but reach out to customer service support when you have questions that you can't seem to answer or figure out on your own. So utilize the platform to familiarize yourself with it. You can do that now if you're not officially ready to step in buying stocks. So, ways to invest. We all have several ways to invest. If you're on a job, if you have a job, that offers a 401k plan for its employees, whether they match or not. If they match, wonderful. If they don't, you can still utilize it. The only issue I have with 401ks is that as employees, we don't take the time to understand what our portfolio is doing. You don't take the time to see what investments the company, your job, is making on your behalf. You are not tracking your money. You're just watching the total. When you could be missing out on having a much larger total if you took initiative to involve yourself with understanding what your investments are. Most companies decide on a general overall bunch of stocks to place their employees in. But you may have a company that you can go to the HR department that handles benefits and ask them, do you have any control on the stock options that are within your own portfolio? Or does it have to be the same throughout the company for every employee? If they give you the option to have some input or manage what your investments are within that 401k, then that's better, because you need to understand where your money is going. Just because it's through your company 401k plan does not mean that their choices are in your best interest. So that's the only issue I have with 401k, that you as the employee, you don't monitor or even know what's going on with your investments within that portfolio. You just looking at the number on how much you could probably borrow now, or how much you're going to have when you leave the company, or whether that be retirement or self-initiated. So yeah, you could actually have a whole lot more if you understood what your portfolio is actually doing. And that's the same with the 413. And that's it's no difference. It's just a different industry within the job force. You have traditional RIA, you have personal and business Roth IRA accounts. If you are a business, you can invest more than you can on a personal Roth IRA account. I think with a personal Roth IRA account, the limit is $6,000 a year, and the business amount has changed. Well, I'm going to do a breakdown of 401ks and 413s and traditional RAs and Roth RAs and custodial accounts on another video when I come back to resume personal investments. So I'm not going to break that down now, because I have a lot of information to get through tonight, and I really don't want to go over an hour. So what are the common choices of stocks to purchase? I've already mentioned some of this before. You have single company stock, you have an ETF, you have an index fund, you have mutual fund, you have bonds and metals. Those are the common choices, but the list is even further than that when it comes to what is the stock market sectors, of which there are 11 different ones, to make it easier to compare companies that have similar business models. Remember, I gave the example of what an ETF is. Like if you walk into the grocery store, if you want to invest in every company that has a product within that store from wall to wall, door to door, that would be an index fund. If you just want to go down the potato chip aisle and invest in those potato chip companies, that would be an ETF. Okay. So I'm going to give a breakdown of the 11 different stock market sectors. You have communication services, which consist of telephone, internet, media, and entertainment companies. Just today, I added to my Robinhood portfolio and included Comcast. I included Comcast in my portfolio today. Number two, consumer discretionary. That would be retailers, automakers, hotel, and restaurant companies. Three, consumer staples. That's food, beverage, tobacco, and household personal product companies. Next is energy, which is oil and gas exploration, production companies, pipeline providers, and gas station operations. Next is financial. That consists of our banks, mortgage finance, and insurance brokerage companies. Next would be healthcare, which consists of health insurers, drug and biotech companies, and medical device makers. Next, we have industrial, which consists of airline, aerospace, and defense, construction, logistics, machinery, and railroad companies. The largest railroad company is Norfolk Southern, and they're stationed here in Georgia. If you are a truck driver, that should be a company that you do some research on and see if it's a good investment choice. Why not make money off the company that you haul freight for every day? And you complain about the rates they pay you on those loads. So invest in their money pool. Next, we have materials, which consist of mining, forest products, construction materials, packaging, and chemical companies. Next, we have real estate, consists of real estate investments, investment trust, and real estate management and development companies. Next, we have technology. This involves hardware, software, semiconductor, communications equipment, and IT services companies. Last would be utilities. Now, this involves electric, natural gas, water, renewable energy, and multi-product utility companies. And I'll mention later, I'll mention it now. Good investments that are recession proof of the market, it would be healthcare, consumer staples, utility companies, and cost conscious retail. Now, there's a full list of major types of stocks. Let me run through this. Let me get me a sip of water, mouth dry. Okay. We have for the major types of stocks. Common stock, which is partial ownership, which I mentioned before, is also called fractional shares. Okay. Next, you have preferred stock, which gives shareholders a preference over common stock that resembles fixed income bond investments. Next, we have large cap stocks, which is categorized by the total of value of all their shares, called market capitalization. Next is small cap stocks, which is the same just for smaller size companies, meaning millions versus billions. Now, for you to be considered a large cap company for stocks, your company has to generate 10 billion and above. A mid cap would be a company that generates 2 to 10 million. I'm sorry, billion, 2 to 10 billion. And a large is 10 billion and above. A small cap stock are companies that generate revenue of 2 billion and below. Okay, going down to millions. Domestic stock is U.S. stocks, self-explanatory. Now, even though the company may be based in the U.S., does not mean that their sales are generated in the U.S. Their sales could be more prevalent or focused on internationally, but the base of the business is in the U.S. Okay, and that's the same thing for international stocks. It's the same thing, just in reverse. Okay, growth stocks is where you can see sales and profits rise quickly within the stock market, but it's a higher risk. The risk is higher in your investments. Value stocks is where the shares are inexpensive and more conservative when it comes to your investments. You make more conservative investments, a little safer. That's what that means. Well, you're strict on your choices, so you're not willing to take a higher risk. You are aware that there's risk regardless, but you're not interested in taking a high risk investment, but you are willing to do a low risk investment. Being cautious in your choices. Next, IPO stock. These are companies that have recently entered the stock exchange market after being approved to go public. Now, some people choose to invest in an IPO because they figure if a company is ready to do that, then they have high value, so it's good to jump in at the bottom and grow your way up. But that's not always a guarantee, so you need to be careful when you choose IPOs with your investments. Honestly, based on my research and hearing from other people that I consider experts in that field or more knowledgeable than me in that field, you really should wait a year so that you could see that company's projections and their annual reporting before you invest. I'm not saying do not. I'm just saying be cautious in how much you initially invest in when it comes to a new IPO. Okay. But you can put a little in, and then you see what's going on in a year. My hair everywhere. You can see what's going on in a year, and then you can invest more into that market. A dividend also can be called an income stock. In addition to your stock profits, you get regular dividend payments, which are made to shareholders as a way of saying thank you. Any company that even the amount of a penny can be considered a dividend. Okay. So a penny per share and up qualifies a company as a dividend stock. Now, remember I also mentioned in previous videos, just because a company offers dividends is not a green light to select that company. You still must do your research on other factors to see if it's a good company to invest. Because you could have a company that's doing poorly in their revenue, in their annual projections and growth, but paying dividends. So again, you got to look at other factors too. Just because a company offers dividends does not mean that that's a green light to go ahead and invest in that company. As I mentioned, as low as a penny can be considered a dividend. But when you're looking at the information on these companies or these ETFs or index funds and mutual funds and all that, if it's a stock that offers a dividend yield, then you're going to look at that and see what it actually offers. A low offered dividend off your profits, of your profits within that investment, again, can be anywhere from a penny to $1.99. A mid-level offered dividend could be $2 to $3. $2 to $4. Okay. A higher offer dividend would be $4 and a penny. That can go up to $5 and some change. An impressive offered dividend is $5 and up, usually between $5.01 up until $8. I do examine a stock further when I see a good dividend offered, like $4 and up. If it's $7 and up, awesome. But again, just because it's there does not mean I'm going to select that stock just because of the dividend rate. So you got to do your due diligence and do your research and your analysis. Don't just jump all in because you see that it offers dividend. I've already explained how dividends work, how you can maximize that that dividend depending on the number of shares that you have within the company. Will help you determine how much dividends. Like, for example, let's say you have a iPhone. Okay. If you have an iPhone, if you willing to spend $700 to $1,000 on the phone, you better damn should be invested in Apple. That should be the very first one you invest in. Because I can't comprehend spending much on the phone, but that's just me. Call me cheap, whatever. But I just can't do it. I love Android. Ain't nothing. I'm gonna leave that alone. So let's say you have invested over a period of time, and let's say you have 10 shares 10 shares in Apple. I'm just throwing numbers out and just giving you an example of how you would look at it. Let's say you have at least 10 shares in Apple. And let's say Apple, again, just making up numbers. Let's say Apple paid a dividend of $7 and some change. Let's say your monthly bill is $100. Based on the number of shares that you have within a stock is used to calculate how much dividends you get on a monthly, quarterly, biannual, or annual basis. Usually monthly and quarterly. So, if you were able to recoup monthly dividends from Apple, and let's say that dividend every month is between $50 and $75, you don't pay. Apple has paid for half of your monthly phone bill already. You have found a way to cover your monthly phone bill. And the more you invest, the more dividends you get when it's paid out, whether that be monthly, quarterly, or biannually. I haven't seen a company that only pays annually. I'm sure there is probably those, high yield ETFs and indexes and mutual funds and stuff. But me personally, I have not seen one that only paid dividends annually. I've only seen monthly and quarterly. So again, remember I told you, when you start with what you can, okay? Especially if it's a stock that you could buy in with fractional shares. You don't have to buy a full stock to get started. You can buy part of that share and then gradually work your way until you get to owning a full share. And you do that by doing the dollar cost averaging. You set up automatic deposits to go into your investment every week, bi-weekly, or every month, and that builds up how much you own within that stock. So eventually you're going to own one share, you're going to own two shares, you're going to own three shares, so on and so on. So the more you dedicate yourself and commit to the process and commit to saving and building your savings with compound interest, you also have a second avenue of generating income with the dividends. And those dividends can be used either. Now, what I do is when I get my dividends, I reinvest it back into the stock, because the amount that I have within my portfolio for each stock that pays dividends is really not that high right now. So there's no point in me getting that little money out and putting it in my bank account to pay capital gains tax on. That's ridiculous. You can program it into the platform itself and have, because they're going to send you notifications to say, hey, would you like to just reinvest your dividends every time they're paid out into the stock? And again, that's building up your investment of that um, stock. So, but yeah, the more you put in, the more you get on a rate of return, and the more you can get on your dividend payouts and use those dividend payouts. Once you get to the point where you can cover a bill, then yeah, take the money out and cover your monthly bill. Especially if you got an Apple phone and you pay that much for it. Yeah. Um, is just as simple as that. Non-dividend stocks. A company is not required to offer a dividend yield, nor is a company required to maintain offered dividends. You may have a company, I'm just going to use Apple as another example. Apple is doing great. They pay dividends to their shareholders because they appreciate. But if they have a shareholders meeting and choose to stop doing dividends or decrease the dividend ratio, that's their choice. But you do have a choice too, because if you have a full share of any company, you're going to get notifications to vote on shareholder meetings. I get them all the time. I will admit, when I go into the platform to look at the topics or the voting topics, some of it's going over my head. I'm like, what in the hell are they talking about? But I do my best for the words I'm having trouble with. I get the dictionary, ask Alexa to explain what that word means. And I'm gradually learning some of the language within these meetings and reports. Of course, I was exposed to some of these reports in college, but that was just me trying to get through the assignment to get a B and above. I didn't retain that information. But anyway, yes, as a full shareholder, it only takes one full shareholder, one full share purchase to be able to be involved within the voting process and decision making of the company, because you are part owner of that company. Regardless of your one share, you still are part owner of that company. Okay. So don't just, so my point of saying about the non-dividend stocks, yes, that can change is rarely done, but it can be done. That's the choice of the company for whatever reason. You can't say, well, you owe me this and owe me that. No, that's not how that is. As long as things are going good and they want to offer dividends to their shareholders, then that's just an extra. But the company is not required to. The only stock that's required to is if it's a REIT, which is, remember I told you, that's any stock that's into real estate, the real estate market. If it's a REIT, they are required to pay dividends. Okay, and I explained why on the previous video. Safe stocks are where the share price make a small movement up and down compared with the overall stock market. It's a low volatile market that are not sensitive to the changing economy. And that would be related to when I mentioned about those markets, those recession-proof markets, the healthcare, consumer staples, utility companies, and cost-conscious retail. That's a safe stock market because it's recession-proof, not affected too much or at all by the economy itself when there's a downfall. Another one is penny stocks. And the best thing I can explain on penny stocks would be cryptocurrency. I mentioned I wasn't going to say too much about cryptocurrency because that's short-term investing. And I really only give focus to long-term investing. My stock portfolio is my long-term investing. The only thing I treat as short-term investing are my cryptos, my cryptocurrency, and Bitcoin. You also have blue chip stocks. I'm not really going to explain the blue chip stocks right now because that's going to be included in another video when I talk about those high yield stocks. When I do that one, it's only going to be about that. So I don't want to bring that up right now. So again, I wasn't going to make this long tonight because I got started late. Supposed to start at 7, but I was at the gym. And I was moving real slow tonight because I just wasn't in the mood. But I got through at least an hour of exercise. And it was a long day. And I've had my eyes either on my phone because I had to spend more money on my car. Lord, I hate Mitsubishi. Mitsubishi is that dealership. The cost of service and repair parts is just ridiculous. Just absolutely ridiculous. It's a nice looking car, but I will never get another Mitsubishi again. Never. So in the past week, I spent a total of $550 on something that had to be done on the car. In the past 4 months, I've spent like $3,000 total on things that need to be done to the car. Yeah. And one of those, and I have my own mechanic and I trust them and that's who I go to. But I had to go to the Mitsubishi dealership last week to get the sensor light reset. And they just charged me $125. I'm like, for what? You just gonna hook the machine to it and just reset the freaking tire sensor light. I've already had the tire sensor replaced. And they was like, Miss King, we see you haven't had a lot of stuff done on this car. I said, oh, yes, I have. I have everything done on my car as soon as it needs to be taken care of. I just don't come to y'all because y'all are a ripoff. Yes, I said that. But I had to go to the dealership for that because they have a special patent on a lot of the parts and electrical stuff on their vehicles. It has to be done at the dealership. No other mechanic has the equipment to do it. Yeah. But anyway, that is it for tonight. Next week, I'm going to switch it up. I'm going to be switching gears to talk about couples finance. And yes, it will be information on what you are not willing to hear, but you should practice. And the reason I'm switching gears for next Wednesday onto the couples finance topic, I want to give the beginning investors to take in all the information that I've shared for the past month, so that they can, familiarize themselves with whatever platform they choose to go on, or just recap on the videos of what I've already shared. So I'm going to come back in a couple of weeks and resume the long-term investment strategies. Okay. But next week is going to be about couples finance. And I chose this one because I had 3 topics I was going to bring up. 3 topics I was deciding to choose from. And I chose couples finance because I know a few people and have had conversations with passengers and have, just seen and heard some things. And yeah, I'm gonna jump on couples finance next Wednesday. So don't forget, Wednesdays are focused on financial literacy. Saturdays are focused on personal and mental wellness. So if you only want to learn the financial literacy side of everything, and if you looked at my past videos, you know that covers everything dealing with money that you're going to deal with or need to deal with through your life, from childhood to seniorhood. So if that's all you want to learn about, great. You don't have to show up for the Saturday segments. And if you do, just know that I don't hold my tongue. I'm going to say what it is. I'm going to say what I'm thinking, say what I'm feeling. So be prepared if you can't handle that. All right. Yep, this is the end. So as always, I hope that you have found value in the information shared. Okay. So until next time, please take care of yourselves and know that knowledge is real power when you apply it. And as always, please take the time to click like and share. The more people that gets this information, especially people that look like me, that have families like me, that have goals in life like me, that want financial security like me, we need to get the information out and we need to share it. I'm not of a selfish mind. I love sharing information that empowers and inspires people to do and be better. I've been like that for all my life, even before I understood what my gift was. So, yeah, and you can't tell me you don't have anyone that you know or in your life of any capacity that you deal with that don't need to learn something new or expand on what they already know to improve your individual life, your kids' life, your family life, for generational wealth and generational wellness. So I'm going to say good night. My body is telling me to go to sleep after I, of course, take a shower. And that is it. Thank you all for showing up, and you have a good one.